real estate investment can be an enticing opportunity for those seeking to build long-term wealth. However, the journey to success in this field is riddled with potential pitfalls that can significantly impact the bottom line. Understanding and avoiding these common mistakes is crucial for aspiring real estate investors. In this video, we'll explore the prevalent missteps that can derail real estate investment endeavors. By recognizing and addressing these challenges, investors can position themselves for sustained prosperity in the dynamic real estate market. Whether you're a novice investor or a seasoned pro, steering clear of these missteps is essential for maximizing returns and mitigating risks. Join us as we delve into the world of real estate investment, uncovering the key blunders that can hinder your progress and diminish your investment potential. By identifying these pitfalls and learning how to sidestep them, you'll be better equipped to make informed decisions and achieve success in your real estate ventures. Lack of research and due diligence. Before diving into real estate investment, it's crucial to carry out thorough research and due diligence. By taking the time to understand the market and inspect properties, investors can avoid potential pitfalls and set themselves up for success. Market analysis. Analyzing the local real estate market is paramount. Understanding factors such as property demand, supply, and pricing trends can provide valuable insights into the current state of the market. Is the area experiencing growth or is it in decline? Are there any upcoming developments that could impact property values? Property inspection. Conducting a comprehensive inspection of a property is non-negotiable. This process can unearth any structural or maintenance issues that may affect the property's value or future profitability. From the roof to the foundation, every aspect of the property should be meticulously examined to ensure that there are no hidden surprises that could turn a promising investment into a money pit. Over-leveraging and financial risks. Real estate investment can be lucrative, but it also carries significant financial risks. One of the most common mistakes investors make is over-leveraging, which involves taking on too much debt to finance a real estate investment. While leverage can amplify returns in a rising market, it can also magnify losses in a downturn. Understanding over-leveraging. Over-leveraging occurs when an investor borrows an excessive amount of capital to fund a real estate purchase. This often involves taking out large loans or using high levels of leverage, such as a high loan-to-value ratio. While this strategy can potentially boost returns in a booming market, it significantly increases the financial risks associated with the investment. Dangers of over-leveraging. Over-leveraging exposes investors to a higher risk of financial distress, especially if rental income or property values decline. It can lead to difficulties in meeting debt obligations, potentially resulting in foreclosure or forced asset sales. Balancing leverage and risk. To mitigate the risks associated with over-leveraging, it's crucial to maintain a balanced approach to financing real estate investments. Ignoring property management. When it comes to real estate investment, one common mistake that many investors make is ignoring the critical aspect of property management. Underestimating the significance of effective property management can have a substantial impact on the overall investment returns. Lack of professional property management. Often, investors may overlook the valuable role of professional property management services. Without the expertise and support of experienced property managers, various fundamental aspects such as tenant screening, property maintenance, rent collection, and legal compliance can become challenging to handle efficiently. Impact on tenant retention and satisfaction. By neglecting property management, investors risk compromising the satisfaction and retention of tenants. Inadequate property management can lead to delayed resolution of maintenance issues, poor communication, and overall dissatisfaction among tenants. Financial implications. Failure to prioritize effective property management can also result in financial repercussions for real estate investors. Inefficient rent collection, improper budgeting, and maintenance oversights can lead to reduced income streams and escalated operational expenses. Strategies for effective property management. To avoid the mistake of ignoring property management, investors should consider implementing comprehensive property management strategies. This may involve partnering with reputable property management firms, staying updated on industry best practices, and actively addressing tenant concerns and property maintenance needs. By prioritizing effective property management, investors can enhance tenant satisfaction, streamline operational processes, and ultimately maximize their real estate investment returns. Remember, effective property management is not an additional expense, but rather an essential investment in ensuring the sustained growth and profitability of real estate assets. Underestimating expenses and overestimating returns. When it comes to real estate investment, one common mistake that many beginners make is underestimating the expenses involved and overestimating the potential returns. Underestimating expenses. Underestimating expenses such as maintenance, property taxes, and insurance can lead to financial strain on the investment. Maintenance costs can often be unpredictable, and failing to budget for these expenses can result in unexpected financial burdens. Property taxes and insurance are also crucial considerations that should not be overlooked. Neglecting to account for these expenses can disrupt the cash flow and erode the expected returns from the investment. Overestimating returns. Overestimating potential returns can lead to unrealistic financial projections and misguided investment decisions. It's important to conduct thorough market research and financial analysis to ensure that return expectations are grounded in reality. Failing to do so can result in investments that fail to meet expectations, leading to dissatisfaction and potential financial losses. Balancing expectations. Finding the balance between realistic expense estimates and achievable returns is crucial for successful real estate investment. It requires careful consideration of all potential costs and a realistic assessment of the investment's earning potential. By avoiding the pitfalls of underestimating expenses and overestimating returns, investors can make informed decisions and set themselves up for long-term success in the real estate market. Failure to diversify investment portfolio. When it comes to real estate investments, diversification is a critical strategy for managing risk and maximizing returns. Failing to diversify your investment portfolio can lead to significant negative outcomes, emphasizing the importance of spreading resources across different property types and locations. Overconcentration in a single property type. Investing in a single property type, such as residential or commercial real estate, can expose investors to sector-specific risks. For instance, a market downturn affecting the residential sector could significantly impact the value of a solely residential property portfolio. By diversifying across various property types, including residential, commercial, and industrial, investors can mitigate the impact of sector-specific challenges and optimize their overall investment performance. Geographic overexposure. Concentrating all investments in a single location can leave investors vulnerable to localized economic fluctuations and regulatory changes. For instance, a sudden decline in property demand in a particular region could adversely affect the value of a solely localized real estate portfolio. By diversifying across different geographic locations, investors can spread their risk and capitalize on diverse market conditions, safeguarding their portfolio against the negative consequences of regional downturns. Lack of asset class diversification. In addition to property type and location, diversifying across different asset classes within real estate, such as rental properties, REITs, and real estate development projects, is essential for achieving a balanced investment portfolio. Focusing solely on one asset class may expose investors to specific market risks, limiting their ability to capitalize on varied income streams and capital appreciation opportunities available in the real estate market. Significance of diversification. Diversifying a real estate investment portfolio is crucial for minimizing potential downsides and enhancing the overall stability and performance of investments. By spreading resources across various property types and geographic locations, investors can effectively manage risk, safeguard against market-specific challenges, and seize opportunities within the real estate market. Limited knowledge of real estate laws and regulations. When venturing into real estate investment, it's crucial to have a solid grasp of the local real estate laws and regulations. Failure to understand these legalities can lead to serious repercussions, including legal complications and financial liabilities. Importance of understanding local real estate laws and regulations. Understanding local real estate laws and regulations is vital for safeguarding your investments. It ensures compliance with zoning laws, property use regulations, and tenant-landlord laws. Moreover, it helps in mitigating potential disputes and legal battles that may arise due to non-compliance. Navigating zoning laws and property use regulations. Zoning laws dictate how properties can be used within specific areas, impacting their commercial, residential, or mixed-use potential. Having a comprehensive understanding of these laws is essential for making informed investment decisions and avoiding conflicts with local authorities. Ensuring compliance with tenant-landlord laws. Tenant-landlord laws vary by location and are designed to protect the rights of both parties involved in a lease agreement. Understanding these laws is crucial for creating fair and legally sound lease agreements, handling evictions, and addressing tenant grievances within the boundaries of the law, minimizing legal risks and liabilities. By gaining knowledge of real estate laws and regulations, investors can minimize legal risks and liabilities associated with property ownership. This includes ensuring proper disclosures, adhering to fair housing laws, and being informed about property tax regulations. Lack of contingency planning. Investing in real estate comes with its own set of risks and uncertainties. Lack of contingency planning is a common mistake that real estate investors should avoid. Contingency plans are crucial for addressing unexpected events or changes in the real estate market and ensuring that investors are prepared for potential challenges. Understanding contingency planning. Contingency planning involves creating a backup plan to mitigate the impact of unforeseen circumstances. In the real estate context, this could include factors such as sudden market fluctuations, unexpected property damage, or changes in interest rates. These plans provide a safety net, allowing investors to adapt to changing situations without incurring significant losses. Importance of contingency planning in real estate investment. Without a solid contingency plan in place, real estate investors are vulnerable to market volatility and unexpected developments. Contingency planning helps investors anticipate potential risks and devise strategies to navigate through challenging times. It provides a sense of security and preparedness, ultimately safeguarding investment portfolios from potential downturns. Implementing effective contingency plans. To create effective contingency plans, real estate investors should conduct thorough market research, assess potential risks, and factor in variables that could impact their investments. Additionally, staying informed about market trends and seeking professional advice can further enhance the effectiveness of contingency planning. The bottom line: in the dynamic realm of real estate investment, the adoption of comprehensive contingency planning is paramount. By embracing this proactive approach, investors can better position themselves to tackle unforeseen challenges and capitalize on opportunities, ultimately fostering long-term success in the real estate market. Remember, having a solid contingency plan is a strategic advantage that can make a significant difference in navigating the intricacies of real estate investment. In conclusion, avoiding common real estate investment mistakes is crucial for building a successful and sustainable real estate portfolio. By steering clear of pitfalls such as underestimating expenses, neglecting market research, and failing to conduct thorough property inspections, investors can position themselves for long-term success in the real estate market. It's essential to approach investment decisions with a strategic mindset, staying attuned to market trends and diligently assessing potential risks. By learning from these common mistakes, investors can pave the way for profitable and rewarding real estate ventures. Continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.